Channelize your funds in capital markets for further monetary growth. Here's how. While you might be earning and saving, investing could allow you the opportunity to earn a higher return. Capital markets are composed of primary and secondary markets. Primary markets. The primary markets are where the securities are introduced for the first time. In this market, companies sell their newly issued securities that may include stocks and bonds to the public for the first time. The process of a company selling bonds or stocks for the first time is called an initial public offering or IPO. All initial public offerings are only launched in the primary markets. The secondary market is where investors buy and sell securities they already own. It is also known as the stock market. In secondary markets, there is no limit to the number of times a security can be traded. The capital markets could be a great place for wealth creation. Right investments in the capital markets can help grow wealth much more compared to traditional savings from earnings. Here are the top investment options. Here are all the top investment options. Equity is used when a company wants money for reasons like expansion of business, starting a new business, etc. It sells a part of the company ownership through shares in return for equity. Debt instruments are like fixed deposits which are issued by a company or government. Mutual funds are one of the most popular and safest return generating investments. The various types are shown here. Derivatives refer to instruments that are further invested in other financial instruments or assets. Types of derivatives are listed here. Foreign exchange instruments are dependent on foreign markets. Types of foreign exchange options are listed here. In exchange trade funds, money is collected from multiple investors and is further invested in other financial instruments, as listed here. Gold is the safest asset to invest in. Pension funds give investors the flexibility to invest a lump sum amount, make annuity payments, or choose a deferred plan. Alternative investment funds are usually used by high net worth individuals, HNIs. Investments in equity outside India through mutual funds have higher risks but may also have higher returns. With tax-saving instruments, you can save taxes while meeting your short-term and long-term financial goals. In order to invest in the given investment options, one should have a Demat account. Demat account is also known as a dematerialized account. The primary use of Demat account is to hold shares and securities in an electronic format. It helps you in online trading like buying or selling shares. All the shares, mutual funds, bonds, government securities, and other investments are saved in a Demat account. No one can trade without having a Demat account. Some of the guidelines for investment in the capital markets are: start early, list your investment goals, decide the amount you wish to invest, assess your risk profile, understand investment options, diversify your investment portfolio, invest regularly, and automate them. It is important on the part of an investor to be aware about the general market conditions and the environment. You must not go by hearsay and do your own analysis before investing. The temptation of high returns based on self-proclaimed market experts must be avoided, and any decision must be based on genuine advice backed by detailed research and analysis. So how does one invest in the secondary market? Step 1. Open a Demat and trading account. This is the starting point to invest in secondary market. Step 2. Select your shares. Log into your trading account and choose the shares that you wish to sell or buy. Step 3. Select the price point. Step 4. Complete the transaction. A risk profile is an evaluation of your willingness and ability to take risks. Risk profile is broadly a factor of your risk capacity, your risk tolerance, and the risk you need to take to achieve your planned financial goals. Here are some ways to assess your risk profile. Different investment instruments have different levels of risks associated with them. Stocks can give you high returns, but also are high in risk as stock prices can be volatile. On the other hand, bonds and fixed deposits have low risks, but also low returns. The amount of risk you are willing to take will depend on your age, income, the number of dependents, risk appetite, etc. To protect the interest of investors in the securities market, SEBI has launched redressal of investor grievances. Investors must be aware that they could approach the regulatory bodies with their complaints.